Here's a summary of Boeing's Q2 2026 earnings call, focusing on key financial metrics, future outlook, risks, and important executive statements, presented in a concise and readable format for audio delivery. Intro music fades. Thank you for joining us today for the Boeing Company's second quarter 2026 earnings conference call. With us are Kelly Ortberg, Boeing's President and Chief Executive Officer, and Jay Malave, Boeing's Executive Vice President and Chief Financial Officer. Today's discussion includes forward-looking statements, so please refer to our SEC filings for details on associated risks and uncertainties. We will now turn the call over to Kelly Ortberg. Good morning, everyone. We're halfway through 2026, and I'm very pleased with our progress. Our teams are increasing production and delivering at levels not seen since 2018, all while maintaining a strong focus on safety and quality. Crucially, the FAA has now authorized Boeing to resume issuing airworthiness certificates for all 737 MAX and 787 airplanes, a testament to the trust we've rebuilt with regulators. In commercial airplanes, we're making significant strides on certification. Testing for the 737-7 is complete, with an amended type certificate expected very soon. The 737-10 has completed its final test flight, and both variants are slated for deliveries to begin in 2027. For the 777-9, we remain on track for first delivery in 2027, with over 55% of certification flight testing now completed. On the production front for the 737, we're ramping to 47 airplanes per month this summer, with early results meeting expectations. The integration in Wichita is progressing well, and we've begun low-rate MAX production on our North Line in Everett, enabling our next rate break to 52 per month. In Charleston, the 787 program has stabilized at 8 airplanes per month. We're working with GE on engine delivery recovery, which is key for our rate 10 timing. The commercial market continues to show exceptional demand, with a record backlog exceeding 6,200 airplanes. In defense and space, we're addressing portfolio risks while increasing output. We achieved milestone C for both the T-7 and MQ-25 programs, initiating low-rate initial production. We've also reached an agreement with the U.S. Air Force to strengthen KC-46A mission readiness. However, we did incur a $280 million charge in the quarter related to the fixed-price VC-25B program due to significant additional resources being invested to support the build and test schedule, aligning with the Air Force on a military certification basis. This investment is crucial to maintain our commitment to deliver this aircraft in 2028. Despite this setback, our defense portfolio is in much better shape than 2 years ago, with strong demand in missiles, munitions, and secure communications. Our global services business is showing robust growth and a strong aftermarket, with no material impact from the Middle East conflict on the commercial services side. Looking ahead, we're on track to be free cash flow positive for the year, supported by our record $715 billion backlog. We're building trust with all our stakeholders and have a stronger foundation for dependable performance. Now, I'll turn it over to Jay for a detailed look at our financial results. Thank you, Kelly, and good morning. In the second quarter, revenue was $24.6 billion, an increase of 8%, driven by solid growth across all 3 segments, particularly higher commercial deliveries and strong defense volume. Operating margin improved to 0.6%. Core earnings per share showed an improvement, resulting in a loss of 76 cents, primarily due to higher segment earnings and lower corporate expenses, partially offset by the VC-25B program loss. Free cash flow was a positive $631 million, exceeding our prior quarter expectations due to favorable receipt timing. This represents a significant improvement over the prior year, driven by increased commercial deliveries and customer receipts. Let's break this down by segment. Commercial airplanes delivered 171 airplanes, the highest quarterly total since 2018. Revenue was $11.8 billion, up 8%, with an operating margin of negative 2.7%, which improved from the prior year due to higher delivery volume and favorable mix. The 737 program is on track to deliver 500 airplanes this year. The 787 delivered 25 airplanes, and we remain on track to deliver 90 to 100 this year, having stabilized production at 8 per month. Defense and Space delivered 35 aircraft, with revenue increasing 13% to $7.5 billion, driven by higher volume across various programs, including classified programs and the KC-46A tanker. The $280 million loss on the VC-25B program resulted in an operating margin of negative 0.2%. However, excluding this charge, BDS operating margin was 3.5%, reflecting better operating performance and in line with expectations for steady margin improvement. We are confident in the path to return to high single-digit operating margins by the end of the decade. Global Services saw revenue of $5.3 billion, up 1% organically, 8% excluding the Digital Aviation Solutions divestiture. Operating margin was 18.1%, down from the prior year due to divestiture impacts and higher costs. Both commercial and government businesses delivered double-digit margins. Regarding our balance sheet, cash and marketable securities ended at $20 billion. Our debt balance stands at $45.9 billion, down $1.3 billion in the quarter and $8.2 billion year-to-date, consistent with our debt reduction plans. Our free cash flow outlook of $1 billion to $3 billion for the year remains on track. The first half performance was better than expected, and we anticipate a positive third quarter free cash flow in the low hundreds of millions of dollars, factoring in a planned $700 million DOJ payment. We remain confident in our ability to achieve our long-term free cash flow target of $10 billion. In summary, we've had a strong first half of 2026 with steady progress against our plan, resulting in a more balanced cash flow profile. We are focused on maintaining this momentum and building sustained free cash flow growth. We will now open the line for your questions. Q&A session summary. Key points: future free cash flow. Management reiterated confidence in reaching a $10 billion free cash flow target, driven by increasing BCA deliveries, performance improvements at BDS, and continued growth at BGS. Specific timing for achieving this and the shape of the curve will be clearer after the current planning cycle. 737 margin improvement. The path back to 2018 like 737 margin levels by the end of the decade involves the dissipation of pricing drags, benefits from increased delivery rates and fixed cost absorption, better mix, and more favorably priced backlog deliveries. 787 engine deliveries. While GE states no engine problem, Boeing acknowledges falling behind on engine deliveries in the first half of 2026. A recovery plan is in place with GE, crucial for achieving rate 10 production. 787 seat certification. Seat certifications are ongoing and will continue for the remainder of the year, potentially causing lumpiness in deliveries, but not impacting aircraft rollouts. Labor relations. SPA negotiations with SPA began early to avoid work stoppages. Management expressed hope for a respectful and productive agreement by the October contract expiration, but is also contingency planning. 777X program. Progress on flight testing is accelerating, with over 55% complete. While the scope of test activities can shift slightly, management is confident in achieving milestones and delivering the aircraft in 2027. Change in corporation scope was contemplated in previous EAC charges, and customer engagement on aircraft configuration and delivery is ongoing. Defense and space profitability. BDS margins are expected to sequentially improve each year towards high single digits, driven by the completion of fixed-price programs, better pricing on new contracts, and execution of the backlog. Fixed-price program risk. KC-46 is considered low risk. MQ-25 and T-7 have normal flight test risks being managed. Commercial Crew, Starliner, has uncertainty related to NASA's launch sequence replanning, but no immediate cost problem is anticipated. Supply chain capacity. While comfortable with 737 rates up to 52 per month, higher rates, 57, 63, will require continued supply chain performance. Boeing will work with suppliers on capital-driven constraints if identified, particularly for Tier 2 and Tier 3 suppliers. BDS and BGS future contributions. BDS is expected to contribute low single-digit billions in cash flow annually by the end of the decade, driven by profitability improvements. BGS already delivers solid free cash flow and will continue to grow. The primary cash flow benefits will come from BCA and BDS. Future aircraft innovation. Boeing is actively working on market readiness, technology, and their own capabilities for a new airplane. Future profitability will likely be driven by innovating on the next generation of aircraft, potentially involving different business partnerships and a different level of engagement with the supply chain, possibly including some increased vertical integration. Wichita integration. The integration of Spirit Aerosystems in Wichita is proceeding as expected, with continuous improvement in fuselage quality. No near-term rate break challenges are foreseen. A $1 billion investment over several years is planned to enhance the facility. Closing remarks. This concludes the Boeing Company's second quarter 2026 earnings conference call. Thank you for joining us. Outro music fades in.